What's this infatuation with markets crashing? It is the weirdest. It's not just the stock market, but just watching my man Graham Stephan, or Steve. One of these days I'm learn that dude's name. Stephan, Graham S. Talk about will the real estate market crash? And he wasn't. I like Graham. I like his YouTube channel a lot. I watch every video he does because he entertains me, and I think there's some good information there. A lot of good information. In fact, I think Graham's one of the best financial guys out there, frankly. A, because he's entertaining, and B, what he says is a lot of it's golden. I don't agree with his take on 15 year. What did he say? 15 year? No. He said a 30 year. I did agree with that. What was he say? Oh, he said don't ever do a variable rate mortgage. I don't agree with that necessarily. I do not agree with that, but I think just saying I'm doing a 30 year fix every single time at all times is I don't agree with that. I made that mistake myself for many years. Just doing 30 year fixed rate mortgages costs a lot of money. Now, obviously, the market could turn against you if you do a variable rate, but I'm on a variable rate right now, and that sucker isn't going anywhere for a while. So let's talk about his video on real estate prices crashing. You look up at Vancouver, Canada. All right, Vancouver, Canada, and I don't follow the market. I literally don't, but I read Zero Hedge and stuff. Yeah, a lot of these naysayers I read just to see what the naysayers are saying. And about a year, maybe 18 months ago or something like that, they talked about how Vancouver, Canada, restricted Chinese nationals being able to buy property up in Canada. And their argument was because that happened, the market fell by 25% or something like that, something extraordinary. And that is a specific area of the country. I have no clue if it happened in Quebec, no clue if it happened in Toronto. I just know in Vancouver, Canada, because the local government restricted certain buyers, inherently that meant the real estate market falls. And I get that. It's no different when they raised the prices or the taxes on luxury goods back in, I think it was George H.W. Bush, because they're going to get the rich, and the price of yachts went down and all the boat manufacturers lost their jobs. There's always something that can happen on specific legislation for sure. But the fact is, just because your yacht went down in value did not mean your Boston whaler did, if that makes sense. There's always these things called substitution, which we call in economics. The price of beef goes up, people are going to buy chicken. All right, that's called substitution effect. It's actually amazing how that works and how governments and politicians, Marxists, don't understand that because, and look, this isn't a bash on Marxist. It is, but this is the problem with socialism as a whole. There's no pricing. If you don't have a price, you have no clue the true value of a good. You have to have a price mechanism, i.e. what someone's willing to pay for it, what someone willing to sell it for. They meet in the middle. That is your price. That's the value. The government can't dictate that. It cannot be top down. It's got to be bottom up. And that's why socialism will fail every single time, because the price mentality has got to drive everything. That will drive your transactions that you make your decisions on hundreds and hundreds of times a day. Is it worth it to buy that or that? If there is no price mechanism to determine the value that you find for a product or the value that the guy who's selling it finds, it's completely gone. The basic efficiency of capitalism and just humanity, you're trading, exchanging value for value, goods and services, gone. That's why it'll never work. All right, but anyway, so here we got the prices of Canada Vancouver fell 25% because of a specific government policy. Let's just fast forward and say here in North Fulton County, Georgia, they raised the millage rates on your property tax. Well, I guarantee you the price of my property will fall as well. And we can see this spot part and parcel in New Jersey. When we moved to New Jersey from Texas, everybody and their mom said, "Why'd you move to New Jersey? It's so much cheaper in PA." I said, "You don't know what you're talking about." I said, "Yeah, New Jersey property taxes are so much higher." And it's true, they were. But the thing was, people with a pricing mechanism are able to determine that. And so they're able to discern, I can pay $500,000 for a house in PA or $400,000 for a house in New Jersey. The $500,000 for the house in PA only costs me $5,000 a year in property tax. The $400,000 in New Jersey costs me $14,000 a year in property tax. At the end of the day, it's the same cost to me. Does that make sense? So because the price with the tax are all in one, it's the same outflow for cash for me. Now you can say, but at the end of the day, Josh, the person in New Jersey who finishes paying that mortgage is stuck with a much, much higher property tax conundrum than the person in PA who's got the mortgage done. I'm like, yeah, I'll worry about that 30 years from now. But no one does that. No young or family is going to say, well, 30 years from now I'll be 65, but I'd rather. No one does that. I mean, I guess some people do. So I'll never forget this, because we thought, I looked in PA, I didn't even look in New Jersey, said nobody can afford New Jersey. And lo and behold, the houses in New Jersey were much more affordable than the houses in PA. Now, when you factor in property taxes, is equilibrium. That's where the pricing mechanism works, and why it works. It needs to be there at all times, so the government cannot dictate prices. It's got to come from the bottom up. In fact, the interesting thing of it, the reason we end up in New Jersey, because of train. So to take a train from, we're looking way out. I've always wanted I've liked PA. I liked it a lot. So I always want to live like halfway between Hershey and Pennsylvania, because we love Hershey. There's a town out there called Downingtown, which I liked a lot. I loved it out there. Anyway, the train to take the SEPTA into Philly was about an hour and 10 minutes each way. And the train to take the speed line from Haddonfield to Center City was 15 minutes each way. The drive to get to the train in Downingtown from the house we actually thought about buying was 15 minutes each way. The drive to get to the train in Haddonfield at the Westmont station was no drive. I could walk. It took me 15 minutes to walk. So it was a non-brainer. We actually ended up spending less money in New Jersey than we did in PA, which is nuts. And on top of that, the lack of driving, the exercise I got and all that too, it was more beneficial for us. Now, if you would talk to somebody and say, but New Jersey is so much more expensive. Well, not in our case. And if I guarantee, if you look around, you'll see how that works. You look at Maine versus New Hampshire. New Hampshire doesn't have a state income tax, doesn't have a sales tax, but it's got incredibly high property taxes. So you just go over one line in Maine, you're gonna have an income tax, and you're gonna have you have an income tax and a sales tax, but your property taxes are much lower, and the cost of your home, when all is said and done, will be cheaper in Maine than it will be in New Hampshire, simply because of what you just said. Now, the nice thing about people in Maine is they can go over the border and buy their goods sales tax free. It's not how that works. That's what we used to do. I've told you a million times. A couple times my dad took me to the Red Sox games. They would always stop in the border at Portsmouth, New Hampshire. Last stop before we had to get, before we were in Maine, to get his booze and his cigarettes sales tax free. And even though my dad and mom were big, libs, they knew how to avoid taxes for sure. Ironic, isn't that? And again, the pricing mechanism. So we said we're going to buy it here. It's cheaper because we don't have to pay the sales tax than if we go to Maine. Now, a lot of times you'll go to Maine, they'll raise the price because there's no sales tax, but not all the time. Or a lot of times you go to New Hampshire, they'll raise the price. But people aren't stupid. They're going to raise the price to the extent that they can get away with it, where they don't drive you to go to Maine. And the funny thing is, if you already stop in New Hampshire, you're not likely to not buy your carton of cigarettes, even if the price in New Hampshire turns out to be more because you already made the stop. That's the price mechanism. All right, so let's go back to what Graham was talking about. And he said it's all local. Real estate is local, so what might happen to you might not happen here, or vice versa. It doesn't matter. But the one thing that always cracks me up is interest rates are going to rise. Where's the proof of that? I was just looking at a chart on Japanese interest rates. 10-year treasury in Japan 20 years ago, 1.5. 10-year treasury today, basically zero. Maybe I think it's 1/2 of one, maybe it's 50 basis points or something. So the interest rates over the last 20 years have not risen. And yet Japan is in a world of hurt financially. Their debt to GDP is like 190% of their GDP. They owe something like 190% of their gross domestic product, gross domestic production. So in terms of their ability to make ends meet, they're in a worse world of hurt than we are relative to their debt to GDP ratios. And yet, have the interest rates spike in Japan? No, not at all. And so I mean, it's just this idea that inherently is going to happen, that interest rates are going to rise and the mortgage rates are going to suffer, the values of real estate. And Graham didn't say that, but he was making the point that some people were saying the real estate market is going to crash because of that. Where's the evidence of that? I mean, this is the thing. You got to be evidence-based here, my friends, and the evidence does not suggest that at all. Now, I'm not saying it can't happen, but if you look at the government, they have and that's what I said just the other day when I was on my live stream. The Fed raised rates like 5, or just the other day I was interviewing my man Amar, but 5 or 6 times last year. I can't remember, but a number of times. And what happened to interest rates for what you would consider interest rates on the mortgage? Nothing. In fact, they've gone down. 30-year treasury right now is at 2.5. 30-year treasury is at 2.5, and yet the Fed raised rates. Remember, raising rates were going to make us all go broke for our mortgages. Didn't happen, man. Can it happen? Sure, anything can happen. It didn't happen though before. So can we stop with this worry so much and saying, "Oh my goodness, our rates are going to go up. We're all going to go bankrupt, and we'll never be able to afford a house." There's just no evidence of that at all. None whatsoever. In fact, if anything, evidence points against it because the Fed has this perverse incentive to keep rates low. They can't. As I've always said, the number one thing on the Fed balance sheet, outflow, cash outflow, is non-funded liabilities, Social Security, Medicare, Medicaid. To fund these, they have to issue debt. I mean, yes, they're paying themselves for the most part, but still, they are paying debt to somebody. Some places get the debt. If they raise the interest rates, the historical norm of a 10-year treasury about 6%, I think it was like the number 2 or number 1 line item on the balance sheet, the cash flow, is going to be debt payments. And they don't have it. It's not there, my friend. So the Fed has every incentive to keep interest rates low. Now, that, again, they control the short term, but the facts are if they control the short term, they don't control the long term. What happens when they raised last year? They raised, but the long terms went down. Because we're just like Japan. We got an aging economy. We have more debt than, I think, what's our debt to GDP? I can't remember off the top of my head. But we have an aging economy. We have more debt than GDP. We're adding to the debt. Trump and Nancy and Chuck, they just got together, and I don't know if they signed the bill or whatnot, but they extended the debt payment so there's no debt ceiling for the next 2 years. I mean, it's just until there's a huge crisis, we're not going to ever have an issue of getting the debt under control. And then you look at Japan, they haven't had a need to. I mean, the facts are Japan still, I mean, they're still kicking on nicely. It's not, look, I don't want to live there. But I mean, this issue that the debt is going to swamp us, make interest rates go through the roof, and make the dollar fall off a cliff, the evidence just isn't there. Now, I'm not saying it can't happen. I'm not saying that. I'm just saying stop this stuff, this panic. Like, oh my goodness, we're going to have this mass sell-off and riots in the street and interest rates through the roof, and there'll never be a sell my house. It's just, I don't get that. I just don't get it. Then my friend Jack up in Virginia was telling me about a guy who says he's worried about a market crash and he thinks the market's going to crash and all that. And I told Jack, I said, man, you better get rid of that guy as a client because he'll never be happy. Because if you tell him to stay in and the markets go up, he's going to be more inclined to want to get out because he says, yeah, I'm glad I'm staying in, but now it's even more likely to crash because the higher it goes, the more likely it's going to crash. And I said, if he stays in and the markets crash, he's going to blame you for not getting him out. I said, you don't have any win there. So if you're a client and hiring a financial advisor and worried about a market crash, do the financial advisor a favor and just get rid of them because you're not going to do them any good because the financial advisor is going to try to convince you to stay in the market. And if you're trying to get out of the market because of your emotional state, you're going to put that advisor's career at risk because if he doesn't capitulate to you because he knows you should not and the markets do crash, you're going to hold him accountable, literally. And some people are going to write a letter against that guy to say he should have listened to you to begin with. And then if the markets continue to go up, you're going to get more and more nervous about the markets crashing. And then you're going to keep calling your advisor to say, hey, get me out now, get me out now. I'm glad I was able to get that extra 10%. Thank you for doing that, but I need to get out now. And your advisor hopefully will say the same thing. No, let's just stay in. And then at some point it's going to crash. And at some point you're going to blame him. And don't do that to him. It's not fair. It's not fair to the advisor. I've seen it happen. That didn't happen to me. But I've seen that happen to people, and it's not right because the idea is you got to stay in, as I told you before. You miss the top 10 days of the last 20 years, you made no money. And people always say, but what if you miss the bottom 10 days? No, I get it, exactly. If you miss the bottom 10 days, you made a hell of a lot of money. The issue is you can't time either side. So because you can't time it, just stay in. All right, my friends, don't forget to smash and do. I mean, hell, Graham, Steven, I mean, he's got a hell of a lot more people than I got, so I imagine you're probably always subscribed to him. But if not, watch his videos. I'm a fan of his for sure. It seems like I had something else I want to say on that. But don't forget, if you have any questions, put them in the show notes, and I will see you next time. Thanks.